Welcome to You and Your Money. Today's episode features Liesl Langevin, Managing Partner Advisory at WHZ Strategic Wealth Advisors.
Turning to today's topic of the unfolding economic impacts of the war in Iran, there's a lot of concern right now around global conflict, oil prices, and what it all means for investors. When you step back from the headlines, how should people be thinking about this?
Yeah, and headlines, anytime you see the headlines, they can be very scary. And of course, we had the deadline on Tuesday. And so, of course, there's always going to be these types of things as you're working through conflicts. And anytime, if you're a recent retiree or you're on the pathway to retirement, you're always thinking, what's the worst case scenario? Am I going to run out of money early on in my retirement? And all of those risks are obviously real. And but it's things that we should be considering are, what do the fundamentals look like? And I mentioned that a bit earlier, and that's what's really going to propel markets. But no doubt, these headlines are very, it's concerning, and you just want to make sure that we get through these things. So,
and we've really seen this play out recently, haven't we?
We have, and you can look at a historical chart of the S&P and look at all the different geopolitical conflicts, or we've got government shutdown concerns. So there's always some kind of something that will jolt markets for a period of time. And but you can see over the last several years, markets have really remained very resilient. And so the S&P, when I gave some numbers earlier on a year-to-date basis, but if we look back a year ago, the S&P is up actually about 25%. The NASDAQ up about 30% or so, and international up again about 25 to 30. So even though we're feeling the year-to-date numbers, we are, we've actually seen on a one-year basis. So that's why, that's not even a long-term historical look back at performance, but it just reminds you that, okay, we've still come a long way, and markets have done okay.
That's interesting because, Liesl, the headlines don't seem to make it sound that way.
Yeah, exactly. Well, and that's exactly right. Typically they're there to try to grab your attention. They want readership, they want viewership, and unfortunately, when we're working with our clients, it's so important that we build into our financial plans with them that these market ups and downs will happen, and that we shouldn't be reacting to them every time they happen, and that any sort of uncertainty should be able to be absorbed into a financial plan. So that's all factored in and really important to remember.
So where does oil fit into this? Certainly the rising prices at the pump are having an economic impact on individuals and families.
Yeah, well, in oil, it really is a starting point. We've seen this conflict play out, and it has had an impact directly on consumers and oil. So when you're going to the pump, like you said, and your prices are a bit higher, that's going to impact things like where consumers are spending in other areas. So when we've got the oil held up in the strait and we're not able to get as much supply, that's going to push up oil prices. And when you have consumers, again, spending more of their income on things like oil prices, that's going to not allow them, again, to spend in other areas. And so that's where inflation too. So we look at the full picture of inflation, and if oil and food and that's being pushed up higher, then we could see things like interest rates increase, because if we've got inflation, we try to balance that by increasing interest rates so consumers aren't spending as much in other areas. So it is a delicate balance for sure.
And inflation already has been a concern.
It has, yeah, and it has over the last few years. Of course, prices have increased. We had over 9% inflation a few years ago, and that's come down. We've done a nice job of managing that. But on a year-over-year basis, inflation, when we look at on food and energy, it's up about 2.5% from last year, and so these, of course, there's always increases, but we try to keep, at least from an economic standpoint, inflation around a 2% on a year-to-year basis, and 2 to 3%. And so we're right in that target, but if oil prices continue to stick, we could see that increase. And again, that'll have more impacts more broadly.
The inflation was happening anyway, but this is kind of stoking it up a little bit with what's going on in the war, isn't it?
It is, yeah, exactly. And like we've been talking about, I mean, you're seeing the higher prices at the gas pump. I would say, though, I mean, if you think about our economy today, it is definitely a bit different than it has been over the last several years. I mean, you just gave a 30-year look back on some weather numbers. But if we look back, I mean, even further than that, our economy is far less intensive in terms of on oil than it was many years ago. And so, you know, people are driving hybrid cars. They've got electric cars. So those types of things are going to help a bit in times like this. But what happens is when you have higher oil prices and then people are spending less on other things, and consumers are 2/3 of the economy. So if they're not able to spend on other vacations or things like that, then it could hurt some other companies across the board. But we're a much different economy than we were many years ago. So it is a headwind, but not as much as you would think.
Let's shift back to the stock market itself, because even before this conflict, there were some concerns.
There were, yeah, and I mentioned a couple at the start. We're focusing on things like AI and the capital expenditures that are going into AI from companies, and how that will have an impact. And in addition to that, because of the investment in AI and investment other places, we're seeing that some of the valuations in companies, because stock prices are so high, are that they are above historical averages. And so that in times like this, when there's uncertainty, sometimes there's a heavy reaction because some may feel that the stock market is overvalued. And so we're in a position where they're doing well, but they're more expensive. And that's also probably why international on a historical basis over the last year has done a bit better than the U.S., because we're looking at U.S. companies and we might feel that they're a little bit overvalued.
And this creates sensitivity?
Yeah, exactly. And so they become, again, when there's uncertainty, it's like, ooh, okay, so maybe we're going to sell some of these stocks, and because we might think that we could trim and hold in cash or other areas that would feel a bit more stable. But again, if you're focused on the long term, it's something that we focus on quite a bit, is that this will cause some uncertainty, but it's not something that we causes a huge concern for us.
You talked about diversification earlier, but isn't there also the issue of concentration risk?
Yeah, there is. And so we talked a bit about tech. Tech is running the S&P right now. So when you look at the S&P performance, a majority of that performance is actually some of those Magnificent Seven performers, which, you know, Apple and Alphabet and Microsoft. So those are what's driving a lot of the S&P right now. And but again, if you've got a diversified portfolio, so the S&P is only part of the overall broad market spectrum, that's U.S. large company stocks. And so if you have things like international and bonds and smaller and mid-sized companies, you are going to you're going to perform over time at a much more steady pace than if you've got everything in one box. And so that's really what we focus on, is that diversification and making sure that you're not having all of your money in just one area of the market.
So that creates a different kind of risk?
It does, yeah. And so, I mean, when there's higher valuation companies like the tech companies, for example, those, again, move with uncertainty. And so when you have geopolitical conflict, it can cause some sentiment shifts and people to become a bit concerned. So that's something that we, again, have been focused on and making sure that we're managing.
So, Liesl, what should investors be doing right now?
Yeah, I'm bringing it back to the fundamentals. So we had a really great jobs report come out over the last month, and so that means that people are employed, and our unemployment number ticked down just slightly. It's in the 4% range, and that's right where we'd like to see it. And so when it comes back to the fundamentals, then you can really say, okay, how resilient is our economy right now? And it is. I mean, it's when you have people spending, that's going to drive revenue for companies, and ultimately that will help shareholder prices. So But I mean, having, again, that exposure across the board is also really important in times like these.
So I guess the bottom line is no drastic moves.
Yeah, exactly. And that's the thing. I mean, you make these small shifts here and there because you know that, or you have a sense that maybe one part of the market will be performing a bit better based on whether it's valuations or where people are spending their money. And so it's making sure that you're shifting appropriately and not so drastic that you're all in one area of the market like the S&P 500 or all in international, and just making sure that you are diversified across the board.
So for listeners now that might be feeling uneasy, what would you say?
Yeah, I would say take a pause for a second, take a deep breath for sure, and ask yourself, is there anything about your financial plan or your long-term plan that has changed? And if so, then of course you'd want to work with somebody to make sure that you're still on track. But time horizons are so important. Even retirees that are entering retirement, they still have a very long time investment time horizon, because if they're retiring in their 60s and we have them living into their 80s, that's a 20-year time horizon. And so you just want to be sure that you don't that these market uncertainty, market volatility doesn't knock you off from that longer term path, because it can. If you sell on the way down, you're starting at a lower period. And when do you get back into the market? I think that's the biggest challenge that we see when we have investors that are nervous or uncertain about what's going to happen. And so staying invested, there's so much data to support that staying invested is really the way to manage your longer term goals and help you achieve them.
For more information regarding wealth management and customized financial planning with WHZ Strategic Wealth Advisors, please visit WHZwealth.com. WHZ Strategic Wealth Advisors offer securities and advisory services through Commonwealth Financial Network, member FINRA SIPC, a registered investment advisor. Fixed insurance products and services offered through CES Insurance Agency. They practice at 697 Pomfret Street, Pomfret Center, Connecticut 06259, and 392A Marrow Road, Tolland, Connecticut 06084. They can be reached at 860-928-2341. WHZ Strategic Wealth Advisors do not provide legal or tax advice. The tenured financial services team strives to support clients in achieving their financial life goals while providing absolute confidence and unwavering partnership for life.